This first video will just be a bit of an introduction about what the goal of external stability is and how we record international transactions. First of all, the goal of external stability is basically just all about Australia being able to pay its way. So it's all about not getting into too much debt and therefore getting to a point where we can't pay off our debt, and that can lead to other countries not being willing to lend us money anymore, and therefore that might hurt economic growth because firms won't be able to invest. So basically external stability is just about preventing us going into too much debt so that we will be able to grow in the future. I will give you a more definitive overview of what the goal of external stability is later in the chapter. But how does Australia trade with the rest of the world? So what we're going to be doing in Chapter 8, and the main part of the first part of Chapter 8 is all about being able to classify all these different types of transactions with other countries. So basically, this includes exports and imports, receiving money to fund our deficit. So if the government borrows money, you need to know how to define where to classify that. Transfers of money in the form of foreign aid, and migrant transfers. So migrant transfers are when, if you're an immigrant working in Australia and you're sending money back home to your family, that is what we call a migrant transfer. How we record payments for international labour, how we record dividends that we receive on foreign shares and perhaps that foreigners receive on having shares in Australian companies. So if they were to invest in Qantas or BHP or Coca-Cola Amatil, how that would be recorded. Any rent that we receive or pay people that have foreigners that have land or property in Australia would also be included. Any interest we pay on our debt, and any sale of equity, so any shares, any property that we sell as well or purchase would all be included. Okay, why do we trade with the rest of the world? Well, the main reason we trade with the rest of the world is because it boosts our living standards. It gives us access to a wider range of goods and services. Most of the things that we buy from day to day are from other countries. It potentially makes things cheaper, but because there's more competition, particularly in industries where we have low tariffs on imports, there's more competition. It gives access to foreign physical capital, so we get access to machinery. It gives access to foreign labour, which often leads to lower wages for businesses and therefore more profitability. It also gives us access to foreign capital or foreign funds. So it gives us access to foreign people's money essentially, and therefore we use that money to expand our businesses. And that's why debt's not necessarily a bad thing. If we're using this debt that we're borrowing from other countries to grow our productive capacity and for investment spending, it's not necessarily a bad thing to be in debt. But the balance of payments is an annual statistical record, so it's recorded every single year of the money coming in and out of the country. So the balance of payments is recorded every single year, and it records both current and capital and financial transactions. So we're going to learn what is included within three different accounts: the current account and the capital and financial account between Australia and the rest of the world. The two accounts in the balance of payments: the current account, okay, that'll be what the next video is all about, and the capital and financial account. The key with this account is that every transaction does not have a future obligation. The balance of payments is called the balance of payments because it's always in balance. Okay, it basically means if the current account is in deficit of a certain amount, the capital and financial account together will be in surplus by that same amount. That doesn't mean both of these accounts have to be in surplus. They generally will be, but it means the total of that balance together would be in surplus. So this one might be -1, this might be +5, and therefore the current account would be equal to +4. They have to be equal to each other. Those two combined have to be equal to the current account deficit. Okay, and that's what this is just talking about. $71 billion deficit in the current account means a $71 billion surplus in the other two accounts combined. That's what the balance of payments is. It's an annual statistical record of all transactions coming in and out of our country for both current purposes and capital and financial purposes. Okay, every time some money comes into Australia, we're going to record that as a credit. So whenever Australia receives money for a financial transaction with an overseas company, that will be, an overseas citizen or anyone from overseas, the money coming in is recorded as a credit. So when we sell exports, when we borrow money from overseas, okay, we're getting the money because they're giving us a loan. They're all examples of credits. If you were to receive dividends, if you had shares overseas, that would be a credit because you're receiving the money. And debits is when Australians are making payments abroad. Okay, so if we're paying interest on our debt, if we're buying imports, they're all examples of debits. Next video, we'll talk about the current account.